The CAMEL score is a critical rating system used to assess the overall financial health and performance of banks and other financial institutions. It was developed by U.S. regulatory agencies, including the Federal Reserve, the Office of the Comptroller of the Currency, OCC, and the Federal Deposit Insurance Corporation, FDIC, as part of the Uniform Financial Institutions Rating System, UFIRS. This system allows regulators to evaluate the stability and soundness of banks in a standardized manner. The CAMEL acronym stands for 5 key components that the score evaluates: capital adequacy, asset quality, management quality, earnings, and liquidity. Breakdown of the CAMEL score. 1. Capital adequacy, C. This component evaluates the bank's ability to absorb potential losses, ensuring that it has enough capital reserves to withstand financial stress. Capital adequacy is essential because it ensures that banks can continue their operations during downturns without needing to turn to external sources of funding. A bank's capital level is compared to its assets and liabilities, and regulators assess the adequacy of both the quantity and the quality of the capital. 2. Asset quality. A. Asset quality measures the riskiness of the bank's assets, particularly its loan portfolio. The risk level is determined by examining the bank's investments and loans to see how likely they are to default. A significant portion of a bank's assets consists of loans, so regulators pay close attention to the delinquency rates, the levels of non-performing loans, and the quality of collateral backing these loans. Banks with poor asset quality may face financial instability. 3. Management quality. M. This factor is perhaps the most subjective. Management quality evaluates the capability and effectiveness of the bank's management team. The primary focus is on how well the management handles the institution's daily operations, risk management, regulatory compliance, and long-term strategy. The leadership's ability to navigate the bank through economic challenges, market volatility, and competitive pressure also falls under this category. 4. Earnings. E. This component measures a bank's profitability and its ability to generate sufficient earnings to remain operational. A bank must have a consistent and sustainable earnings flow to ensure it can meet its expenses, reward shareholders, and reinvest in the business. Regulatory agencies examine both current and historical earnings to assess trends and identify potential issues, such as declining profitability or excessive risk-taking in the pursuit of profit. 5. Liquidity. L. Liquidity assesses the bank's ability to meet its financial obligations, especially its short-term liabilities, without facing significant financial distress. A bank with strong liquidity can access sufficient cash or liquid assets to meet immediate demands from depositors or creditors. This is particularly important in times of economic downturn or financial instability when access to capital markets may be constrained. Evolution and introduction of S for sensitivity. In 1997, the CAMEL system was expanded to include a 6th component, known as sensitivity to market risk, S. The revised CAMEL system now takes into account a bank's vulnerability to changes in market conditions, such as interest rate fluctuations, currency exchange rates, or commodity prices. This component is crucial because it reflects how external economic factors can affect a bank's financial standing. As market risks have grown in importance over the years, this addition has provided regulators with a more comprehensive view of an institution's risk profile. Scoring methodology. Each component of the CAMEL rating system is scored on a scale from 1 to 5, with 1 being the best, indicating strong performance and minimal risk, and 5 being the worst, indicating serious deficiencies that threaten the institution's viability. The final CAMEL score is a weighted average of these 5 components, or 6 in the case of CAMELs, though the weighting of each component may vary depending on the regulatory authority and the institution's specific situation. A lower overall score is better, as it signifies a healthier institution with fewer risks. For example, rating of 1. The bank is in excellent financial health and has minimal risk factors. Rating of 2. The bank is in good shape but has some minor issues that are being addressed. Rating of 3. The bank has moderate weaknesses and needs to take corrective action. Rating of 4. The bank is facing significant financial stress, and corrective measures are urgently needed. Rating of 5. The bank is in serious trouble, and there is a high risk of failure. Who has access to CAMEL scores? Access to a bank's CAMEL score is restricted. The primary users of CAMEL scores are the bank's regulatory agencies and supervisors. This score is not disclosed to the general public or investors because it contains confidential and sensitive information about the financial health of the institution. Making such information public could lead to negative consequences, such as bank runs or loss of investor confidence, especially if the bank's score is low. CAMEL scores are shared among regulatory bodies that supervise different aspects of financial institutions. These include the Federal Reserve, the FDIC, and the OCC in the United States. The agencies use the CAMEL score to decide on necessary interventions, including additional oversight, mandatory corrective measures, or, in extreme cases, recommending the closure or merger of the bank. In addition, the bank's senior management and board of directors also have access to the CAMEL score. This helps them understand the regulatory concerns about the bank's operations and guides them in addressing weaknesses or risks identified by the regulators. How is the CAMEL score used? 1. Regulatory oversight. The CAMEL score is one of the primary tools that regulatory bodies use to determine whether a financial institution is operating in a sound manner. Banks that score poorly may face heightened regulatory scrutiny, such as more frequent examinations, stricter reporting requirements, and limits on certain business activities. If a bank consistently receives low CAMEL scores, regulators may force the bank to take corrective actions, such as raising additional capital, restructuring management, or altering its business practices. 2. Early warning system. A key benefit of the CAMEL score is its role as an early warning system for potential financial distress. By regularly evaluating and scoring banks based on their performance in the CAMEL categories, regulators can identify problems before they become too severe. This proactive approach helps prevent bank failures and mitigates the risk of contagion in the broader financial system. 3. Mergers and acquisitions. When financial institutions are considering mergers or acquisitions, the CAMEL score plays a crucial role. Regulatory authorities will assess the CAMEL scores of both entities involved in a potential merger to ensure that the resulting institution will be sound and stable. Poor scores in certain areas may prevent a merger from proceeding or require significant restructuring before approval. 4. Insolvency and bank failure. In cases of severe financial distress, the CAMEL score may trigger regulatory actions to wind down or liquidate a failing institution. A score of 5 is a signal that the bank is likely on the verge of failure, and regulators will act swiftly to either facilitate its closure or find a buyer for the institution's assets. 5. Supervision of foreign banks. The CAMEL rating system is not confined to domestic banks in the United States. Foreign banks that operate in the U.S. are also subject to CAMEL evaluations to ensure that their U.S. branches or subsidiaries comply with regulatory standards. This ensures a level playing field and maintains the stability of the U.S. financial system. To sum up, the CAMEL score is a vital tool for assessing the financial health of banks and financial institutions. While it is not publicly disclosed, it serves as a critical measure for regulators to ensure the stability and soundness of the banking system. By evaluating capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to market risks, the CAMEL score helps regulators maintain oversight and intervene when necessary to prevent financial instability. It is an early warning system and a regulatory tool that has become indispensable in the supervision of both domestic and foreign banks. Thanks for watching. Please subscribe.